70.5%. This number has no power. None. It isn't support. It isn't a law of markets. It's the middle of a range somebody picked. And I'm going to spend the next 10 minutes convincing you to care about it anyway. Because this entry, stop, target is what I've owed you for 3 episodes. Episode 1, I told you the market has 4 states. Episode 2, I gave you the clock. The workbook gave you the log. Today you get the trade. All of it, including the half nobody teaches. We're going to take one trade completely apart. One leg, one retracement, one entry. And by the end, you'll have a number. Because a setup without a number is just an opinion. Everything starts with one thing on the chart. And if it isn't there, there's no trade. That's not it. That's it. Big bodies. One direction. Barely a pullback. Somebody bought and did not care what they paid. And the reason that matters isn't the move. It's what the move tells you about the person who caused it. A price-sensitive buyer works and order quietly. They wait, they scale in, they try not to move the market. A buyer who needs the position takes whatever's offered and moves it 50 pips. That's the footprint, not the direction. The urgency. And one thing to correct, because you'll hear it constantly. Institutions never buy at a premium. They do all the time. An index fund buys at whatever the close is. Month-end rebalancing buys at a price it doesn't choose. Hedging flow doesn't wait for a discount. What's true is narrower and more useful. A desk that gets to choose when prefers a discount. Those are the ones leaving footprints like this. Those are the ones worth following. So you've got your leg. Reach for the fib tool. No, not yet. Because a leg that's still running has no top. And you can't measure to a level that hasn't finished being made. You need a confirmed swing high. And that is 3 candles to define it. And 1 more to confirm it. 3 to define. A peak. And a lower high on each side of it. That's it. That's a swing high. Every trading platform on earth will draw this for you, and most traders still get it wrong, because they mark the highest wick in the neighborhood instead of the middle candle of 3. Then 1 to confirm. The next candle that closes below the body of that peak. Not below the wick. Below the body. Now it's finished. Now it can't get any higher without invalidating itself. And now, only now, you measure. Here's the whole idea in one line. And if you take nothing else, take this. Every leg has a top half and a bottom half. Above the middle is expensive. Below it is cheap. That's it. That's the concept. The middle has a name, equilibrium. Fair value. The price at which the leg is neither a bargain nor a ripoff. And here's the rule that follows, which is almost embarrassingly obvious once it's on screen. In a bullish leg, you don't buy the top half. Not because it's forbidden, because you'd be paying more than the people who caused the move. They got down here. And this is where most people lose money without ever knowing why. You can have a perfect setup, clean structure, textbook displacement, an order block sitting right there, every box ticked. And if it's in the top half, it's a bad trade. The setup can be right, and the price still be wrong. That's the filter. Everything else in this methodology sits underneath it. So, below the middle. But where below the middle? Not all of it is equal. 51% is technically a discount, and it's barely worth getting out of bed for. The zone that actually pays sits deeper. 62% to 79%. And the number you'll hear quoted is 70.5, which is, and I want to be honest about this. The exact middle of 62 and 79. That's the whole derivation. It isn't a measured level. It isn't special. If your trade needs 70.5 rather than 70, it was never going to work anyway. The fib isn't magic. It's a tape measure. The only question it answers is how far back has this come relative to the move that made it. And you could answer that with a ruler and a bit of arithmetic. The zone is the point. The numbers are just how you find it. Now, price bleeds down into the zone, and then it does something that makes almost everybody close the tab. It breaks the low. Every stop under there is gone. Everybody who was long is out. Everybody watching a breakdown just went short. You'll hear this called a stop run, or turtle soup. Quick credit where it's due. Turtle soup isn't an ICT term. It's Linda Raschke and Larry Connors from 1995. Named for fading the turtle trader's breakout system. Worth knowing where your vocabulary comes from. And the mechanism is the least mystical thing in this entire methodology. If you want to buy a large position, you need someone to sell it to you. Not a few people. A lot of people at the same moment at a price you like. There is exactly one place on a chart where a big pile of sell orders is sitting at a known price, waiting to fire automatically. It's under the obvious low. It's the stops. So price goes and gets them. Not to spite you. Because that's where the sellers are. Right? You're about to be in this trade. Where does your stop go? Below the low of the step. Not below the zone. The zone is where you're buying, not where you're wrong. And not a fixed 20 pips, because the market has never once cared what round number you chose. You're wrong if price closes back below the low it just swept. That's the level that means the whole idea was incorrect. So that's where the stop goes. And the market decides the size of your risk, not you. So let's finish it. Entry in the zone. 70.5 because it's the middle, and the middle is as good a place as any. And the target isn't a guess either. It's the same logic upside down. Where's there a big pile of buy orders sitting at a known price? Above the old high. Every breakout trader's entry. Every short stop loss. That's who the people who bought down here are eventually going to sell to. 7.3 pips of risk. 39 of reward. 5.4 to 1. And that's why the discount matters. Not because it's a secret. Because entering deeper doesn't change where you're wrong. It just makes the distance to being wrong smaller. Same target. Same idea. A third of the risk. For things kill this setup. All four are visible before you're in. 1. No displacement, just drift. If you can't see the leg from across the room, there's no leg. Don't measure noise. 2. The retracement never reaches discount. It stalls at 40% and goes. That's not a mistrade. That's a trade that didn't exist. 3. Price closes below the swing low. Not a wick, a close. The leg is dead. Delete the fib. 4. The old high has already been taken. Your target was the liquidity above it, and somebody already collected it. There's nothing up there to aim at. Any one of those, and you don't have a setup. You have a chart. So that's the model. Displacement. Confirms swing high. Discount. The zone. The sweep. And a stop that the marketplace is for you. Go and find one. Not a trade. To measure. Take the log you built last week. Find one displacement leg and mark where the zone would have been. One leg. That's the whole homework. And tell me in the comments where you got. not whether it won, what the ratio was. That's the number that actually tells you whether the entry was any good. Next time, what to do when you're already in, and priced as something you didn't plan for. Measure one leg. See you then.